Okay, let's dive into this. Welcome to today's explainer. Look, if you've been paying any attention to the economy lately, you know the deal. Entering the property market, it feels like an absolutely impossible dream for so many people right now. Skyrocketing property values have left everyday folks feeling like they're permanently locked out of the wealth-building power of real estate. But what if I told you there's a secret to investing in real estate, one that doesn't require a massive down payment, it doesn't require a mortgage, or, even a house? Today we are going to unlock the true power of investing in real estate using fractional funds.
So here is our roadmap for today. We'll be looking at high prices and why they aren't a problem, what REITs actually are, their core advantages, how to use a global allocation strategy, the impact of interest rates and risks, and finally, your new asset allocation tool. All right, let's get into it.
Section 1. High prices, zero problem. Now, what's really interesting about this is we really have to address the elephant in the room, those skyrocketing property values. The traditional path to real estate wealth has always been buying a physical property. But with values reaching astronomical heights, everyday people are just getting priced right out of the market. And honestly, it can feel incredibly discouraging. But our source material offers a brilliant piece of advice here. Don't let high housing prices limit your imagination. Seriously, this is the exact mental shift you need to make today. Just because you have limited funds absolutely does not mean you're permanently locked out of the real estate market. You just need a different entry point. You need a method that allows your fragmented, smaller pools of capital to actually participate in these massive real estate markets. Section 2. What are REITs?
So if we aren't buying a physical house, how on earth are we getting into the market? Well, the answer lies in global real estate investment trusts, which are commonly known as REITs. Think of a REIT as a financial tool that essentially securitizes real estate investments. Instead of you taking on a massive, stress-inducing mortgage all by yourself, professional institutions pool funds from the general public. They take that massive pool of collective money and use it to invest in and operate large-scale income-generating properties. So you're essentially buying shares of a massive real estate portfolio.
And listen, we aren't just talking about single-family homes here. Oh no. We are talking about massive commercial office buildings, sprawling shopping centers, vital medical centers, and even the data centers that literally house all those cat videos on the internet. The institutions manage these properties, and the real magic happens when the rental income and the capital gains from these high-value assets are collected. After they deduct the necessary expenses, those profits are distributed right back to you, the investor, in the form of dividends. Section 3. The core advantages. Just think about the stark contrast here for a second. Traditional real estate requires millions in upfront capital, or at the very least a massive down payment. It's also highly illiquid. You can't just sell the kitchen of your rental property if you suddenly need cash, right? And let's not even get started on the tenant headaches. You're the one dealing with leaky toilets at 2 a.m., the stressful vacancy periods, and all the maintenance. By contrast, REITs allow you to start with fractional capital. Because they trade on the stock market, they offer stock-like liquidity. You can buy or sell your shares with literally the click of a button. And the absolute best part? Professional management handles all the operations. You never have to fix a roof or screen a tenant. You significantly lower your barrier to entry while massively increasing your flexibility.
And this brilliantly illustrates one of the absolute coolest and frankly most surprising aspects of REITs, the 90% rule. Look, governments rarely hand out massive corporate tax exemptions, but in countries like the US and Singapore, REITs actually get one. But there's a catch. They get this tax break on the strict condition that they legally distribute at least 90% of their annual income to shareholders as dividends.
Because of that mandatory 90% payout rule, REITs are structurally designed to put money in your pocket. This transforms them into a highly reliable, consistent source of passive cash flow. They aren't just hoarding the profits, they are legally required to pass the vast majority of it directly back to you. It's a real game changer.
Section 4. Global allocation strategy.
Okay, so we've established that REITs are a fantastic asset, but investing in just one single country? That leaves you super vulnerable to that specific nation's economic cycle. When we look at the global market to disperse those economic risks, distinct regional flavors really start to emerge. First up, the US. It's the largest market in the world, and it's incredibly cutting edge. You aren't just buying malls, you're investing in communication towers and self-storage facilities. Then we have Japan, known as J-REITs. They benefit uniquely from a long-term low-interest rate environment, which makes their commercial offices and logistics centers highly attractive. And finally, Singapore, or S-REITs. They are really renowned for their focus on international assets, offering highly competitive dividend yields. By blending these together, you're basically protecting yourself from a downturn in any single region.
Section 5. Interest rates and risks.
Now, while real estate is historically great at beating inflation, mostly because rents and property values generally rise right alongside the cost of living, I have to ask you directly, is it completely risk-free? Of course not. If you're going to be a savvy investor, you absolutely need to understand exactly what causes REITs to stumble so you aren't caught off guard. And the biggest headwind for real estate by far is the cost of borrowing money.
Actually, let's walk through the exact chain reaction you need to understand here. Step 1, central banks decide to raise interest rates. Step 2, because real estate relies so heavily on borrowing money, the REIT's financing costs immediately increase, which directly eats into their profits. Step 3, at the exact same time, because interest rates are now high, safer investments like government bonds start offering better returns. Suddenly, the dividend appeal of a REIT drops compared to those risk-free bonds. And finally, step 4, as investors move their money over to bonds, the REIT experiences price volatility.
So the crucial point to take away is this. You cannot just buy a REIT, set it, and completely ignore the macroeconomic weather. You literally must monitor regional monetary policy, meaning what are the central banks in the US, Japan, or Singapore actually doing with their interest rates? Furthermore, you need to keep a really close eye on local property supply and demand. Knowing these economic indicators is absolutely crucial to help you mitigate risks across your entire global portfolio.
Section 6, your asset allocation tool.
Bringing it all together, based on our source material, the ultimate takeaway is that global REITs act as this indispensable, truly bond-like tool within your asset allocation. They are bond-like specifically because of that incredibly stable, legally mandated dividend payout we just discussed. But unlike traditional bonds, they also offer the potential for long-term capital appreciation as the underlying properties increase in value over time. They provide these really unique anti-inflationary benefits, making them pretty much ideal for investors looking for long-term growth paired with reliable, steady cash flow.
We have covered a lot of ground today. We talked about the power of fractional investing, the legal magic of that 90% dividend rule, the smart strategy of global diversification, and why you absolutely must monitor interest rates. So I want to leave you with this final thought to consider for your own financial journey. Are you ready to add real estate to your portfolio without ever having to actually buy a house? The tools are right in front of you, ready to be utilized. Thank you so much for joining me for this explainer, and I really hope this empowers you to look at your asset allocation in an entirely new light.